My mission is simple, to make you money. I'm here to level the playing field for all investors. There's always a bull market somewhere, and I promise to help you find it. Mad Money starts now. Hey, I'm Cramer. Welcome to Mad Money. Welcome to Cramerica. Other people want to make friends? I'm just trying to make you some money. My job is not just to entertain, but educate, teach, and put it in context. So call me at 1-800-743-CNBC or tweet me at Jim Cramer. Styles are always changing on the Wall Street fashion show, but it sure seems like the senior growth stocks are suddenly back in vogue. I'm talking about the stocks of companies that deliver like clockwork, the ones that make you feel like a dope for parking your money in an index fund because they perform so much better than the rest of the S&P 500. So on a fabulous day for the bulls, where the Dow roared 177 points, S&P vaulted 0.68%, Nasdaq came 0.58%, in part because there's still one more story about face-to-face trade talks in China next week. You know what this action reminds me of? No, not the 2000s, where stocks routinely blew up. Not the past decade, where we've rallied kind of pretty steadily. Not even the run-up to the dot-com apocalypse in 1998 and 1999. No, aside from the run in the semiconductors, which benefit from any sign that the trade tensions may settle down, today's move was actually reminiscent of the beginning of the great bull market. That's right, of the 1980s, the first huge bull market. Yep, we had the same winners now as we did back then, when the United States transitioned from an industrial economy to a post-industrial economy. And it was a big deal for Merck to surpass Ford or GM in size. This morning, we heard from a classic consumer packaged goods company that has struggled mightily in recent years, Kimberly-Clark, and it blew away the numbers. The maker of Kleenex had 5% organic growth. That's extraordinary. But that's not even the most impressive part. What matters to me were the gains in the emerging markets. Listen to what the CEO, Michael Su, had to say on the conference call. In China, organic sales were up double digits compared to a soft performance last year. In diapers, our net price realization was helped by reduced and more targeted promotional spending. All right, so let's translate this into the language you and I know. In other words, Kimberly-Clark spending less and making much more. Oh, boy, that is a recipe for printing money. It's not just China. In the Association of Southeast Asian Nations, their organic sales were up about 10%. Continued strength in Vietnam. Eastern Europe, that up 20%, about 20%, driven by double-digit volume growth and positive pricing because of terrific new products. That means Kimberly-Clark raised prices and nobody balked. While Kimberly-Clark stock gave up most of the gains after we got positive news on the trade talks in China, I cannot overemphasize the importance of this development. When I worked for Goldman Sachs in the 80s, we used to recommend these senior growth stocks routinely because we knew the developing world was becoming increasingly wealthy, increasingly middle class. So they wanted better diapers, better toilet paper, better tissues. Now these emerging markets countries are richer than ever. And thanks to relentless innovation and good online marketing, Kimberly-Clark is back on top. No wonder the stock's been okay. Although with an aging population worldwide, it's less about selling Huggies and more about selling Depends. Of course, it's not just the rest of the world. Kimberly-Clark put through multiple price increases here in America to cover the rising raw costs. Do you know what? Those price increases stuck, but now the raw costs are falling again, thanks to lower commodity prices, which translates into better gross margins. Let's see. Higher sales, higher prices, lower input costs, incredible demand from emerging markets. It's like we've hopped into the Wayback Machine to the 1980s. I bet we get some analyst converse to Kimberly simply because the stock had an intraday reversal. Whenever you met a client who owned Kimberly-Clark or thought about it, you know what you'd immediately recommend? Hey, how about some Coca-Cola? KO, knockout, we used to call it. KO for the same exact reason you recommended Kimberly. It worked great for years, but then it peaked in 1998 as senior growth stocks went out of style. Money poured into tech. Now Coca-Cola is back, and it is back big. CEO James Quincy has reignited the business. This man is money. Coca-Cola had 6% organic growth in a lot of its businesses. It's a huge throwback to the 80s. The company's talking about gigantic secular growth in developing countries again. They represent 80% of the world's population, but only a quarter of the commercial beverage market. We thought Coca-Cola was saturated overseas. Nope, they opened more than 750,000 new outlets in Asia alone this year. Believe it or not, a boring old company like Coke has once again become an innovation machine. Almost a quarter of their sales come from newer reformulated products, up from 15% just 2 years ago. The smaller format soda cans are working. Same goes for the Coke energy drink. The Coke brand itself had its highest volume growth in 10 years. 10 years. No wonder the stock rallied 6%. Both companies have roughly 3% dividend yields. Both of them are able to buy back huge quantities of stock as opposed to the tech companies, which usually offer stock. It might as well be 1985. Forget the Wayback Machine. This is Back to the Future, Part 2. Before you hop into the DeLorean, though, remember, this is still the same old rotating market. There's not enough money in equities to move the whole market at once. The rally in these classic senior growth stocks come at the expense of high flyers like FANG and the Cloud Kings. Witness the pullbacks of Adobe, VMware, Salesforce. That's a big difference from the 80s when Kimberly-Clark, Coca-Cola, Procter & Gamble, Colgate, PepsiCo, Merck, Schering-Plough, Pfizer were the real growers. And the tech companies like Motorola, Texas Instruments, and IBM took a back seat in terms of growth, although Texas Instruments reported an awesome number this very evening. But I think there could be more money going the way of the Cokes and Kimberleys because this very evening we also learned that the Justice Department is investigating the giant tech companies like Apple and Amazon, Alphabet, Facebook, see if they're stifling competition. Now, this is a change of heart from the department, which had been a staunch defender of these companies' abilities to compete globally. But now they will have to face scrutiny that could stifle their own creativity. That's my view. I don't mean to be too cavalier, but you know what? Ultimately, this is going to prove to be a buying opportunity. Why? Because the wheels of justice grind so slowly. So what does the reversion to the healthy consumer packaged goods stocks today, what does it mean for the market? What does it mean for you? First and foremost, you've got some fallback stocks. Some very good stocks to fall back on if this market stumbles. As freight costs and commodity prices keep coming down, as advertising becomes cheaper thanks to more targeted digital ad buys, the gross margins for these companies will continue to expand. Normally, I'd be worried about encroaching private label brands, the knockoff merchandise, so to speak, but it just hasn't happened so far. It's on all the conference calls. People, wait, it hasn't happened. Because the consumers feeling flushed, they're staying with the name brands, particularly all that innovation. Second, if the Fed does cut short-term interest rates, these consumer packaged goods stocks will have even more competitive yields versus the CDs that so many of you have been hiding in. Third, remember, these are slowdown stocks. If we get a weaker economy, as people keep saying, they're still going to be able to make the numbers, and the shares will become a lot more attractive. Fourth, Coca-Cola and Kimberly are addicted to returning capital to their shareholders via dividends, via buybacks. If the companies keep putting up fabulous results, I think management will be tempted to boost their payouts and the repurchase programs. That's fantastic. Fifth, on any breakdown in the trade talks with China, which I expect, don't forget these two companies do tons of business in the People's Republic. They're not the most obvious China plays. They'd absolutely benefit from any progress here because progress makes it less likely to be tariffed or boycotted or even banned into oblivion. Don't think it'll happen, but trade talks go well, you'll make money too. Finally, even though their stocks have run a great deal, Coke more than Kimberly, Wall Street still hasn't really gotten behind them. Actually, it's kind of fought the increase the whole way. I do expect multiple upgrades from both these names, even though they've run tremendously of late. This is really the first quarter where these consumer packaged goods companies have the wind at their backs. They've been raising prices repeatedly to offset the rising raw costs. But for the most part, that barely covered the increase in commodity prices. Now those costs are coming down. But the prices you pay at the store, they're not going down. Boom, instant margin expansion. Their targeted ad spending via Alphabet or Amazon or Tmall or Facebook lets them reach the right audience for less money. It's all falling into place. Can you imagine if the dollar ever went down? So let's stop complaining that stocks have run up too far too fast. Let's stop with the endless parlor game about whether the Fed's going to raise or not cut or raise this or that. I don't give a darn. The bottom line is that these consumer packaged goods stocks haven't run that much versus the techs. They have incredible pricing power, vast untapped markets overseas, and terrific dividends. If I'm right that this is like the 1980s all over again, it means the likes of Coca-Cola and Kimberly-Clark have a lot more room to run. I want to go to Phil in New Jersey. Phil!
Booyah, Dr. Cramer.
Booyah.
Back in June, Amazon launched its juice store for professionals. When that announcement came out, Ulta stock plummeted. I saw an opportunity. I purchased Ulta at $350 price. Since then, the stock has been trading in a range and has barely moved up. Its earnings are around the corner. Is this a good stock to keep, or should I sell it?
No, I want you to own it because they've got the best loyalty program in the country. And loyalty program is, you can read from the Starbucks release they had today. There's nothing like a great loyalty program. It's absolutely fantastic. I would bet on Mary Dillon. If the stock gets hit, just buy more. The company knows how to handle even Amazon. All right, people, we are seeing a return to the 1980s growth today. So stop complaining. And stop talking about the Fed. And let's settle in to companies that are doing a real good job winning in the supermarket, the grocery store, and clubs. On Mad Money tonight, Disney is powering more than just the movie theater box office. I'm sitting down with the CEO of Hasbro, best stock in the whole market today, to see how it's reaping the rewards. Then there's a snack attack on Wall Street. But which company could come out victorious? Because I'm focused on these 1980s group stocks. I will be comparing Mondelez with Hershey. And one Shark Tank superstar is teaming up with Chase to help young entrepreneurs. I know Jamie Dimon is getting behind the guy. He told me so himself. Don't miss my exclusive with Damon John. Stay with Cramer.
Don't miss a second of Mad Money. Follow @Jim Cramer on Twitter. Have a question? Tweet Cramer. #MadTweets. Send Jim an email to madmoney@cnbc.com or give us a call at 1-800-743-CNBC. Miss something? Head to madmoney.cnbc.com.